Hello, welcome back. An esteemed subscriber of our channel asked to make a video about 3M, a very well known company that I have actually bought many years ago. And I think it deserves some financial analysis here to see whether right now, after dropping a little bit, it's a potentially interesting buy. This is a very well known company, and somehow it still has $83 billion in market cap, which I would expect it to be higher, to tell you the truth. But we're going to be examining the company and also use our normal discounted cash flow model and see whether it's actually a good time to buy the stock or we should be waiting for a better price. So let's take a little bit of a closer look by starting with the outstanding shares of the company. And as you'll see here, they have been decreasing, and this is a side that you'd love to see. And actually, this is some quite steep decrease over here. It looks like the company has been buying buying shares back in droves, really. So that's very nice to see. Very cool. So yeah, this is a very good sign for investors. Now it's worth noting that the company is paying a 4.10 dividend yield here, and this has been increased because the price of the stock has been going down. But let's take a look at the dividend and see whether it's safe. And the way to determine that is the payout ratio. The payout ratio is basically a ratio that tells you how much of the net income of the company is paid out to stockholders. Now, typically you want to see less than 50%. This is a little bit more than what I'd like to see, yet it's probably safe. I wouldn't expect the company to have a lot of trouble actually, fulfilling the dividend here. But I'd monitor it, and if it ever reached maybe 70%, then I would have to potentially like trim a little bit of my holdings here if I were holding 3M. So think about it if you are willing to actually buy the company. It's a little bit high. So the income statement is what will be coming up next. And you will see here that the total revenues have been about similar. A little bit of an increase some years, a little bit of a decline. And over here in 2021, the company had one of its best years with 10% increase in revenue, which hasn't seen for many years now. So that's good to see that the last year actually had the biggest revenue growth for the company. And the net income over here, you will see that it's sitting at almost 6 billion, up from 4.8 back in 2017. So growing, not massively, but still growing. The balance sheet of the company, you would expect a stellar balance sheet from such a company. So the total assets of the company have been growing from 38 billion to 47 billion. But let's take a look at the total liabilities. They are sitting at $32 billion, so less than the total assets, which is good to see. And of course, that means that the total equity of the company is increasing from 11.6 billion to 15.1 over here. So nicely increasing year over year. Good stuff. So the cash flow of the company, cash from operations, which is also increasing from 6.2 to 7.4. So yes, you can understand with this kind of company you should not be expecting explosive growth. It's mostly about paying you some dividends, and as long as it is safe, it will be nice, and maybe appreciating over the years. Now, when that happens, I kind of like to get these companies at a cheaper price, but we will examine the pricing a little bit later. So the cash from investing, the company has lately been investing a little bit, but it's mostly capital expenditures, as we can see, and it's typical for the company. Their last big investing was actually in 2019, that is, and they spent about 5 billion here for cash for some acquisition. Cash from financing, again, it's in the negative because the company has been repurchasing common stock like crazy. So they do consider their stock to be actually pretty cheap. And we will examine that. And they have been paying also some common dividends, which are slowly been increasing here, as you can see. And the free cash flow of the company, 4.8 billion in 2017, 5.8 in 2021. So again, not some steep increase, but still increasing. Notice that in 2020 they actually had more than 2021. So the actual free cash flow has actually dropped from 2020. Maybe that actually had a little bit to do with the company's stock price coming down a little bit. The multiples of the company are pretty nice here. Less than 3 is what I'd like to see. This is what I'm seeing here. Very good. And what about the profitability? Wow, I didn't expect that actually. The profitability at 42% is very high for a company of that sort. So it looks like they're great with investing their equity, really. So that's very nice to see. Cool. So the solvency of the company does have quite some debt actually compared to equity. So I'd like for them to trim that down a little bit. Although it doesn't really, it doesn't really scare me that much, because the company has been making quite a lot of free cash flow. And as we examined here, you can take a look at the total liabilities. Total liabilities being at 32 billion over here, and the company has been making 6 billion in free cash flow. So it would take about 5 years to pay off all the debt if they wanted to actually pay them off right now, which they shouldn't, of course. But it would take about 5 to 6 years, and I'm fine with that. That's relatively normal. I'd like it to be a little bit less, but I'm still okay with it. I don't expect the company to have any troubles really with debt, based on what I'm seeing here. So next up, we're going to be taking a look at the stock valuation evaluation tool here, and we're going to be using what the company has been doing financially to project what we want to be paying right now in order to make some money into the future. And so you will see here that the revenue growth of the company has been sitting at 3 for the 5-year average, 3.3, 2.6, 9.8. This is a company that's very, very steadily growing, and you shouldn't expect much growth. It's more like a value company right now, which is paying some dividends but not growing insanely. Although this 10% last year is not bad at all based on what the company when compared to what the company has been doing in the previous years. So that's better. I also have a new thing that I have added, the analyst projections here. Some analyst projections have been low. They have been projecting 30 billion, which is a decrease from 35 the last year, decrease of 13%. But on average, they project actually 7.5%, and the high one is 30%, which I think is super high. I don't see the company reaching that. But based on what I'm seeing here, I think I want to go with something like 2, 3, and 5 is what I would like to use here, what I'd like to use. I think this is very overblown here. I don't expect the company to have negative revenue growth. Hasn't happened. And the worst one was 2019, where they actually grew minus 2%. I just don't see how this minus 14% will happen. So the net income margin that I'm going to be using is fairly similar, which is nice to see. The company has been converting net income at a very steady rate, although this is rather low. I'd like it to be a little bit higher. But we kind of know what to use here, and so we're going to go 14, 15, and 16. And we're probably going to be in that range, more than likely. The free cash flow margin is also very similar. Another good thing to see, the company is converting free cash flow, is converting net income to free cash flow at a steady rate again. And what I'm going to go with here is 95, 100, and 105. And that will be fine. So the annual return here that I typically like to see is 13%. I want to be making a little bit more than 10%, which I would be making if I would buy an S&P 500 ETF, which is about 10%, and then I hit calculate, and I'm seeing here that the company, for the medium estimates, we are very, very close to the current price. For our high estimates, we're actually below our high estimates here, which are not terribly high. I think this is relatively normal here, to tell you the truth. Very well achievable from the company, I believe. And the low ones are at 100 and at 120. So right now, as I'm seeing the company, what I would do with it is, if I wanted to hold a little bit of 3M and get some dividends, I would start buying a little bit and potentially average it out as it drops, if it drops. So I wouldn't go all in right now because I'd like to get some better price. But if it went below, so right now it's 145. If it went below like 135, below that number, like 132, 133, this is where I would definitely buy the company. Now you have to bear in mind that the company will, for the most part, be paying you dividends and not so much being a company that will grow insanely in terms of its stock price. It would potentially achieve some growth, but you should for the most part expect the company to pay you dividends. As you can see here, for instance, for the last month, the company has been at around the same level, 142 to 148, and this is typically how these kinds of companies move. And so you should be expecting to be getting some dividend, but not explosive growth in terms of the stock price. So if you are fine with that, I would definitely go for the company. It will pay you some nice dividends over the years. 4% is nothing to sneeze at. But bear in mind that dividends are not very tax efficient because they are taxed twice. They are taxed on the company level for the net income, and also they are taxed when you actually get them. So they are taxed individually per investor. So they are not the most tax efficient mechanism because they are double taxed. And so, there's it's not the best really for for your investing, generally speaking, although it is good in the sense that you are getting some extra income. And so again, if you want to be using it for some passive income, go for it, and it could have a nice a nice spot in your portfolio. As I said, I actually bought the company many years ago, so I like it. And as the price drops, I like it even more. And I do like to diversify, have all sorts of different companies, growth ones, value ones. As long as they are good companies, I don't care. I like to get them, and I like to have in my portfolio. So hopefully you enjoyed the video and it helped you a little bit with potentially deciding on 3M. And if you did enjoy it, please leave a like and subscribe if you're not a subscriber. I'd love to see you around. And in the meantime, take a look at this video that I made today. And it's about Alibaba growing 10% after yesterday growing 37%. So we are seeing some massive increase in Chinese stocks right now. Thanks a lot for watching the video, and I'll see you in the next one. Bye-bye.